I would need some preparation. I don't know how we could organize our conversations. Maybe in the format of presentations, or I don't know, a free chat. I don't know. Perhaps we should talking about um, how we organize our talks. What do you say?
Sure. Anyone who wants to talk, just let me raise hand.
I think it's the format we have with the other room with Jerry. It's really great because there's one person that brings up topics and the others follow. So Derek has given us quite a lot to, to talk about, and so I can start following if you guys are happy, and perhaps it's not a surprise that my obsession and my really favorite um, ideas are how we can go about and model volatility, but more importantly, how we can feature um, anything that is not strictly considered to be part of a signal into our risk management process. Because the biggest, if we want to call it contention point that shows up in talking to Jerry, certainly Jerry had made that very very clear. He doesn't like vol targeting, vol adjusting, anything that has to do volatility scaling, anything that has to do with that, because his um, his rules and his system is you simply follow the trades, take your losses, and let your profits run. Um, in in my experience, this is very difficult to do, not because it's difficult to make money, but it's because at least at least in my experience, giving back profits, it's really really expensive in terms of emotional capital. As quite possibly as much as you know um, experiencing experiencing losses, and so being stopped out. So my interest is in can we do something better than just letting profits run? And again, it opens up um, you know, a huge topic, which is how you measure volatility. What is volatility? Derek correctly said is semi-variance is not one-sided. So there's perhaps we can start from here and see if people have experience and suggestions.
Sure. I think volatility is something that everyone kind of knows. Let's see. I'm sorry. I'm trying to invite Richard. And I think it's a good starting off point. I think we can follow the kind of loose topics that I had given at the beginning, and see how we can do that. And maybe I'll just kind of reply to Bruno. Um, the modeling of volatility, I think, is extremely important, and it can be done in many ways. But as with any tool, it's how you use it. And I think Bruno brought up something I had brought up before, and people who are familiar, semi-variance as a measure of volatility as opposed to um, just the kind of two-sided volatility. And I think identifying why we're modeling the volatility and what you're using it for, because there are plenty of good volatility models out there. We know that they cluster. We know there's Arch-Garch family. We know that it's a mean reverting thing. We know that it's easier to forecast than price. But to take that volatility and say, okay, this is how I am going to um, protect the upside is maybe a blunt instrument, if that makes sense. How do I use it to protect the upside? Um, Without going into anything super proprietary, I think that the semi-variance is really important because if we know things are clustering, we're very specifically concerned about the direction of the volatility. And I think that, kind of spinning off the trend following aspect, if you are going with that, you are capturing You're trying to capture semivariance, some directional semivariance. And if you're able to measure that and look at that as a more precise instrument than the total volatility, that's a different thing. And it also kind of comes back to understanding the factor that we're going after and using the factor framework. Um, if you could model that and you could find out when that factor is confident, not confident, or expanding or contracting, that gives you a different signal than just looking at price. And it allows you to analyze it in a different way. That's why I personally like um, continuous signals, or rather confidence intervals, more than a pure binary. And because it gives you this kind of flexibility and it allows you to already model a continuous process, which gives you different tools. Because if you're looking at something that's -101, yeah, okay, you forecasting a sign is easier than to forecast a value, but if it's a normalized value, then you can get some confidence intervals. Um, it's about taking that and saying, okay, I know I want to deal with this continuous process as opposed to, just changing the sign. I don't know if that made sense.
One of the things perhaps we could discuss here is we can get a bit mischievous now that Jerry's not around, and we can start talking more in quantitative terms. And one of the things I'm very interested in is this notion of serial correlation in the series, and measures such as the Hertz exponent as a measure to filter trades within serially correlated environments and non-serially correlated environments. So this is where I think it sort of ties in with this notion of volatility expansion, which you're talking about, Derek. But perhaps there's within this sort of format, we can start getting a bit more technical, looking at the quantitative aspects of trend following or divergence and convergence. Because when we talk about, when you talk about the different factors that are at play, when I'm thinking about our method of quantitative trading, I can really only see the information that's present in the data series, which really sort of limits this notion of factors, which allow me to sort of precisely define a method to attack a particular form of arbitrage. So, in quantitative terms, there are sort of limited things that price can do, but certainly through quantitative techniques, we can filter out regimes where there is this presence of a genuine signal in that noise, which we can capture, and perhaps there's you guys can we can thrash about ideas about how to attack the signal better.
Derek spoke about factors. The first thing, and obviously this is to completely violate Derek's rule to not get too much into technical details, but obviously feel free to push back. But when you talk about factors, you talk about some sort of latent factor. It's not present in price itself. So that tells me that you're sort of using some models, structural models, or the first one could be principal component analysis, except it doesn't really work for this type of estimates. But there are, of course, all sort of latent models that you can use. So it would be very interesting if you could tell us a bit more about that. One thing, just to offer some suggestions. One thing that I've been pointing in the direction of are Gaussian processes, and so I can see why they can work. And of course, the problem with using such a model is that you have many more parameters to estimate, and you get to a point where you have to sit in front of an investor and say, "Hey, you lost money yesterday because the eta parameter, which controls the sparsity in my Gaussian process model for volatility, just moves from 2.27 to 2.24. Obviously, these are completely made up values, but the point is, you sort of lose track. And going back to Jerry's simplicity, you add all sorts of layers of abstraction and complication, which make things difficult. So yes, I mean, the biggest problem in modeling volatility is striking a balance between the complexity, not the complexity, but the degree of complication of your model and your ability to explain it.
Okay, I'll hit Richard's first. Autocorrelation, I've done a lot of work on the Hurst exponent before. I found it to be lacking quite a bit. This is because it assumes a normal distribution underneath, and so you may get signal like less than 0.5 or above 0.5, simply because the underlying process that you're measuring is not normal, and that becomes a problem. I think keeping it simple is better. Looking at autocorrelative lags of like lag 1, lag 5, lag 10 is a lot easier because it doesn't take that much of an assumption, I guess, because the Hurst exponent can look back at a certain amount. Maybe I think it's 20 by default or something, and then you can see where the autocorrelation is moving because that is also time varying. So I found it not to really help signal just straight up. Going into Bruno's point, parameter estimation, Gaussian processes. I have tried Gaussian mixture models before. I find them better than a straight up Gaussian process because you can keep the sum of them Gaussian, but you can get like different modes, so to say, like they can sum up better. It does get super complicated. The issue of the parameter estimation, I think, is one that affects all quantitative traders, and I don't try to explain that to the client. There are just too many. Some of my strategies run 300 different signals that become aggregated at some point, and saying that this one signal, which has X amount of parameters, changed the parameter space by this parameter times some multiplier or scalar that ended up this trade winning and this not. You in the end you do the big idea. I come from the school of having a theoretical idea before that is executed using quantitative research and then systematized. If the client can understand what it is you're trying to capture, not only do you have a narrative, which clients love, but you can explain to them that it was specifically either that phenomena was not existent at that time and it didn't occur, or that your ability to capture that was different. And obviously you don't want to give the second answer, but it could be the fact you weren't tuned for it at that point, and then if you have an adaptive method to adjust your parameters to update over some period, then you should be learning from that. And it doesn't have to be ML, but I mean it could be, to be able to learn to be adaptive to that set, and then just making sure that your kind of parameter space has enough of everyone looks for that hill or that hump or that mountain, and the thing that it's robust enough across this surface that even with some standard error, you should be kind of in the sweet spot, but it really depends on what you're trying to do.
Derek, you touched on the weakness of the Hurst exponent that assumes a normal distribution. That's a topic I've been struggling with. A lot of the finance theory assumes that we have normal distributions everywhere, and that's plainly wrong. It's right just enough for us to draw some conclusions, but when we go to practice, it's extremely hard to make it work. Do you guys have any alternative? I don't know. My question is because I'm running some back tests on a trend following system, and I would like to compare my systems, but I'm not sure how I can do that from a statistical point of view. I don't know. For example, I would like to compare the hit ratios of my models, and I have a
You can
sample
definitely run
that
t-tests.
yeah, but the t-test would assume that each trade is independent. Would assume that each trade has a when I go to the it converges to a normal distribution. It assumes a lot of things that we know that are not true.
This is where ML shines. And I'm not saying predicting, but ML helps you get rid of those assumptions. Uh, Also, mixture processes, like I mentioned before. Um, or you can set like a gamma distribution or something, because as long as it's relatively well known, we solve numerically and you're able to find the difference. For Bruno's specific point, I have found MCMC, uh, Markov chain Monte Carlo, to be really helpful. Um, it helps me in a lot of ways because it doesn't assume anything, and I can compare the distributions of certain things. And you do have some short-term memory of like one. So it does maintain some of the generalized autocorrelation, both of your return series and of the underlying, depending on what you're modeling. So for example, you could say, okay, this is how I do it. Say you have a system A, and system A is what you're running now, and you want to say, okay, if I have system A plus B, is that any better or worse than system A? You could do MC and compare the distributions. You can look at how much they overlap or how much of the tails are touching and see, okay, based on these potentially non-normal or probably not normal distributions, um, if it's actually giving you any benefit or not. And that works for system health as well. Honestly, it's like one of the biggest tools in my toolbox. Standard Monte Carlo uh, has a lot of issues with it because it's assuming IID. But this way, I think, is quite helpful because you could MCMC your sharps, you could MCMC your hit ratios, you could MCMC um, your thing over and over again, infinite amount of times, and find out all of your performance statistics, and then compare the distributions in a non-normal way.
Yeah, but what are you sampling from for your MCMC run? From the I don't know from the back test, from the sample of trades on your back test.
It can be from the sample of trades on your back test. It could be running your back test on synthetic data across many different things with different thresholds. So you might want to see what's the boundary condition given different amounts of autocorrelation in the underlying series. You find the boundary condition for your system, and then you can say, actually, system A is performing in lower autocorrelation regimes than system B. Or you could say, I'm actually going, and you would use MCMC to generate those data, or it's just standard, stochastic process to generate. But then you would still have a distribution of these returns or this performance statistic. The issue with doing the pure test itself is it's not enough data. If you were going to do it on the performance statistics, all of those things, you would still need to be able to generate synthetic data and backtest across all of those. And you could just use standard Monte Carlo with some kind of chunking, maybe, or some kind of way to preserve the autocorrelation function at whatever lag is showing the most significant in the series. But it's kind of like a look ahead because like you would have had the whole series and check it, but it's trying to be as close as possible without adding too much complexity because you just have one parameter.
Great, I like that. By the way, I'd like to congratulate you for the last post on your blog regarding synthetic data. That was really enlightening. Thanks, Derek.
Can't give away too much of my secrets, but I actually don't think that the secrets do much, to be honest, because um, it's all like you can show someone all of the tools, but like it's if I give you all of these things, you're not going to be a master carpenter. Like if a guy gives you his toolbox, but I think it's important to share because these are questions we all have, and I mean I don't want to be dominating the speaker role or whatever, but I really feel that there is a collaborative environment that exists in like an academic space, but in our space, especially if you're managing money, you have to be extremely careful on what you say or what you can't say, whatever, because the IP is not yours. Um, so I find it very hard, but also I am surrounded at my firm by discretionary traders. So just having a place to kind of let loose and let my hair hang out, so to say, although I don't have that much hair, um, is very cool.
I feel the same, and I think it was from Jerry that I learned that you can tell most of your secrets and still people won't trade just like you because they don't know how all these tools, just like you said, how they all combine themselves. And I feel that in the quant space we have a much more collaborative environment than in the discretionary space because the tools themselves are not the end. They're just a step that and we all choose what tools we will combine. I I like a lot this effort of this particular room for us to share our thoughts. Okay, on this synthetic data issue, I struggle a lot with the hypothesis we do with the assumptions we do when we run our tests. I struggle a lot with normal distribution, and well, I'm just being repetitive here. Do you guys think of any alternative
One thing that you
for
can
the?
do when
Sorry, go on, Bruno.
one thing you can do when you work with synthetic data, you can completely do away with the normal distribution. As Derek was saying, I mean, you can use any kind of distribution to create that data. And with that, you can add all sorts of disturbances in the mass of the distribution, in the tails of the distribution. You can add all sorts of skews, positive, negative, and whatever you want. So it's not that complicated. And Derek spoke about MCMC, and it's one extra tool. It's even more advanced than using synthetic data because obviously, before doing MCMC, you need to specify a full model, and you need to kind of work in a Bayesian assumption where you sort of reverse the flow of reasoning, and you use an inductive model, which is, by the way, how I do most things as well. I'm actually looking to apply this thing to volatility model because in my workflow everything starts from there. It drives capital allocation as well as it kind of scales up signals that are continuous signals. And I obviously second Derek's comment. This framework really is only possible if you work with continuous signals. With discrete signals, things become too lumpy to sort of apply. I think this framework. But back to your question, Bruno. You start you have building blocks when you work with the synthetic data. You can do whatever you want, and it's relatively easy to fire up some IPython notebook, I presume, or whatever tool you're using, and start generating data away that has the properties that you want. And I'm sure that all of us do the same thing here. So just take an instrument, let's say the S&P 500, measure some sort of statistical properties, and sort of figure out what kind of distribution you want to model. Go out and code it in, and you then start generating Monte Carlo assumptions with that. But yes, I think Derek is absolutely right. The Bayesian framework really adds value because you can you can definitely recover a posterior that has not just a point estimate, but a full distribution of parameters or results that you want to take a look at. So I'm very happy that we got Derek's sign of approval for using MCMC.
I think it's so funny what that ending part where it's like my approval. I think that it's yeah, we're just all here to share, but I really appreciate everyone being here. I mean, it's super cool.
Bruno, I have the same problems with you regarding this normal distribution, but the way I've sort of dealt with it is I've said to myself, well, under this framework of normal distributions, we've got these incredibly powerful statistical tools under the assumption that they're normally distributed. So the way I always assess things is I use the normal distribution or the statistical tools as a basis to, it's what I call a basis of exclusion, where I say, let's apply real market data to that framework and let's see how that distribution varies from that normal distribution. And when I'm using this sort of exclusionary model, I'm saying to myself, well, does it vary with positive skew to the right of that distribution? Does it vary with negative skew to the left of that distribution? Does it have leptokurtic peaks? All of those sort of things are sort of, it's basically using a hypothesis, a null hypothesis. It's sort of always examining in relation to this normal distribution framework. So really, it actually is a very powerful method through this process of exclusion to actually get some concept of reality of what is going on. So I find it actually quite helpful using these statistical models, but not for the content that they contain therein, because then you're dealing with random notions of randomness, independent series, etc., which have no sort of value for arbitrage. But it certainly is a good way in dealing with the reality of these markets. It has these very high levels of noise within them, and it's sort of trying to sort of isolate what is the randomness in that market and what is the non-randomness in the market, and what direction is that non-randomness, and how can I exploit it. But it's a bit like discretionary trading, chart patterns, because these methods we apply are always lagging in nature. So the key is, how do you do this on the fly with, and Derek was mentioning machine learning. And I'd like to know more about how we can do this with getting much more rapid, valid signals, as opposed to this lagging feature in hindsight when we apply this quantitative basis to sort of isolate the signals from the noise.
Bruno, have you heard of the deflated Sharpe ratio or the probabilistic Sharpe ratio?
I have, yes. I don't know if the question is to me or the other Bruno, but I have.
Yeah, I was to the other Bruno, but I mean,
Oh, sorry.
the Bruno P. But it does have a kind of a framework to deal with the non-normality when you're doing testing on your returns. It just kind of came up in my head. Maybe you could use that framework to kind of do the deflating of your hit ratios and other things, because it goes specifically to kind of what you're trying to get at, like performance statistics, and it does it in relatively close form.
Okay, great. I'll look I'll look it up. Full disclosure here, I'm an economist by training. I have a strong econometrics background. I understand what you guys talk when you guys talk about MCMC and Bayesian statistics. But when it comes to the nitty gritty of turning that into finance, that's where I'm still learning and learning a lot from you guys. So thanks again.
I mean, I think the whole normality, non-normality thing is probably the biggest legacy of say the 1400s, 1500s, 1600s mathematicians that devise these kind of models. And that's why I find Ole Peters' work so interesting. I mean, it's not specifically about alpha generation, but I think he's at the London Mathematical Laboratory during doing ergodic economics. And I find that very interesting on how he's looking at the world these days. I mean, I haven't been able to distill what he's said into something like a system, but I find that using more modern mathematics methods, how he's applying that is quite cool. Maybe that will give you another reading homework, Bruno C.
Sure thing. Thanks.
Going into, I guess, maybe what Richard was talking about on getting into signals earlier, or identifying things earlier using machine learning. Okay, I'm not a machine learning expert, I can tell you that, but I feel like there's like a level of voodoo that you go beyond, that either it works or it doesn't, or it explodes because your parameter estimation is all wrong. And I find that to be in the prediction space, and specifically price prediction. Returns prediction, sign prediction is a bit easier, but that's not enough to kick off your trend. So I find that to be a place where I don't really feel ML is there yet, or at least my understanding of ML to help. Where I have found ML to be the most beneficial is to remove assumptions, removing the assumptions of normality, removing assumptions of no skew, and potentially modeling features of the distribution that we can't get from, like, some well-known distributions like a gamma distribution or a beta distribution, or whatever. That is where I've really found the reduction of error in some of our estimations at my day job. But to say that you can use it to identify some additional signal, I think is, at least in my understanding, I can't do it. I'll just leave it at that.
Perhaps I can offer an example of what I've been really looking at recently in the realm of machine learning. In my quest to solve this volatility problem, I've approached a number of ML consultants, and I came away thinking that there's really the main paradigm they use is that of throwing a lot of data at the problem, seeing what sticks, and then they give you a tool that effectively does some dimensionality reduction and allows you to explain things a little bit, but doesn't really get into the nitty-gritty of precise measurement. And what I mean by that is, the question they're trying to solve is this. I have a signal I'm trying to extract out of some series, and this signal is influenced by a number of factors. So I'm using all my factors and giving you the 6 or 7 or 10 or however many you want that really are the most relevant for you. So you then go and say, okay, I can explain X%, however much I want to recover from my my signal or my variance or whatever, and that's it. So the explanation is sort of done this way, but they're not really telling you anything about the dynamics of this signal, how strong, obviously how strong you can measure, but how persistent, how much persistence you can expect and things like that. So to get back to your point, Richard, using machine learning to as a trading tool, as a signaling tool, it's very, very difficult. And part of the problem is it's that in finance we have a small data, not big data, on top of the usual non-stationarity, non-normality assumptions. But the biggest problem seems to be like all those guys are trying to do is augment, and then eventually they'll find a way to explain your problem. But it doesn't seem very robust in this respect. I mean, we want to do better than that. I want to do better than that before using machine learning. And yeah, and it seems like everybody talks about it, but in finance is not very well understood, apart from obviously Marcos Lopez de Prado and his Bible that he wrote. But even then, it seems like a lot of his tools are yeah, I mean, like, they work, but they work not as well as, as advertised, at least in my.
Yes, Bruno. Look, I've sort of approached this from a more physical systems perspective, and when you start talking about the adaptive nature of these systems, emergent foundations, all of these things, it just highlights how systems we can't use conventional models such as highly statistical models based on these primitive assumptions to basically get a gauge of what we can do, what signals we can derive. It's you've almost got to take a computational logic where you've got to recreate the entire system from scratch through a computational process which is open ended. And progressively with these emergent sort of foundations that build over time, the system wanders, we get new emergent fabric. So it just highlights to me how perhaps Jerry's right, and we need to go back to this level of simplicity because the complexity is so intractable that methods such as machine learning and the things we're talking about are really sort of in their infancy, and you'd almost need an infinite time to get these methods to sort of give you something you could use practically with your trading. So that's why I do love the principle of let the data tell you what to do. But on the other hand, I'm thinking to myself, Christ, there's so much complexity in this stuff. Maybe I've got to really reduce my models, simplify, go back to the really fundamental sort of broadest parameters that are free of these assumptive conclusions, and that's the way we should really approach this chestnut.
Obviously Marco Lopez the Prado is amazing, and I think he's done a lot of great work, and I have definitely read it all and a big fan. And I do think it shows specifically what is the weakness. I think the bridge I cannot cross is what Bruno P was saying, was that you throw all these things out in, you get something out, but it's not necessarily logical. As in, like, I would not have made that logical conclusion, and that may be a benefit. It may reveal something that I hadn't seen before. However, because these underlying phenomena are time varying, the issue of stability is unknown. Like, also he mentioned we're dealing with small data, and I think that's why HFT firms or people trading very fast intraday can use ML, while people trading higher time frames cannot. It's just due to sample size. And the limiting factor there is specifically that aspect. Um, I know of people who are able to, basically predict, or order flow imbalance is quite a common one that's well documented. Something like that, where you can get predictions up to, the next tick or the next few ticks or the next 8 seconds or five. I mean, it's getting faster and faster. I mean, it could be like the next, um, you know, 20 milliseconds or something these days. But when you start to reach out, the impermanence of that decreases, and because they're getting, tens of thousands of trades a day, or maybe hundreds of millions of trades a day, and hundreds of millions of data points a day, it becomes tractable for them, and maybe they don't necessarily care what is that underlying function. But for us, if we're sitting in front of an investor and we're trading even short to medium term daily signals, our sample size is really low, and the people we're in front of are different. When you think about those HFT firms, they're private prop firms. They don't have to explain it to anybody else but themselves. And as long as they all created that system, they understand how it works and are taking the risk. If you don't really see someone like Jane Street, opening up funds. It's not what happens. And I think that's a differential as well to the client facing, limiting that, because if the PM cannot explain, the client won't buy for sure. So that is maybe the bridge to.
Actually, where ML in our sector works. And again, this is not my work; it's Marcos Lopez de Prado's. But his hierarchical risk parity does, I think, a better job at teasing out dependency than a simple correlation structure. So we've been bashing ML in finance, and I think we should be bashing it. But it's not all bad. I mean, there are some very good things. I didn't know what Derek was speaking about, trying to remove assumptions. I never used it, but I'm going to try and do that. But certainly, I've used it and it works for, clustering algorithms and recovering dependency structures, or correlation, if you want to use a simpler word.
Oh, I agree with that. And talking about hierarchical risk parity, um, specifically because it reduces error when you invert the covariance matrix. I mean, that's a big step. You've removed exponential error from a simple calculation that everyone is doing the same way, and that in and of itself is an edge. I mean, it's well known now or whatever, but not everyone is calculating their correlation that way. I can bet that if you look at most of the larger people or whatever, maybe they are using it. I don't know, but most people are happy with a straight up correlation when it's really just looking at linear dependence as opposed to nonlinear dependence. And that's the kind of thing I think ML can attack. Very specific problems that we know have an issue, and then you can look at this type of thing and try to remove an error that might not be better. So I think Bruno P was talking about like PCA. Um, there are definitely better machine learning methods to extract factor importance to explain for your explained variance, like forest or trees or something like that, better than just a straight up PCA. But I know how PCA works. I mean, it's intuitive to me, and we can do it this other way. And then I have a mental analogy to get there on why that would work, why we're separating these things, why it's split up in this way. But the pure black box factor model, or even like this quantamental stuff, where they try to uh, put in all these macro factors and it comes out with, say, some estimate of GDP, I find a bit hard because, yes, you could look at the factor loadings and determine which are important now today. Maybe you could do some estimates on those factor loadings and see how stable those factor loadings are over time. And then you could detect a regime change when those factor loadings move out of, I don't know. It can get infinitely complex. Um, but you do get rid of that normality assumption, which is the biggest one I see.
True, and there's even more advanced methods than trees. There's Disney, which a lot of people use for straight ML, and manifold learning is called this wonderful field of recovering factors from data. But again, my experience has been a bit hit and miss. I know that even in this room, there's people that use it a lot, and you, Derek, told all of us, the other week that when I was complaining about being difficult to sort of identify a timing model for when to kind of expand and contract risk taking. You do seem to have had good fortune in using some of those methods. So of course, without giving away the trade secrets, but it would be nice to at least point us in the direction, and you seem to be very good at doing that. And tell us what out of those, this zoo of tools and techniques, what helped you, make better timing decision with respect to your risk taking and then your signals or whatever it is that you're using it.
Sure. Okay, so it comes to the quantamental thing, but I'm not discussing a point estimate of something. And it kind of comes back to network effects, and which was one of the topics that we were discussing. So, if you take a global set of factors, you could say you add your corporate paper of different grades, you've got your GDPs or whatever. What I specifically am looking at is for fragility, and you can measure that however you want. But defining fragility is when the correlation should break down. You can use traditional. It's very hard to point in the right direction. You can use traditional models to find out what are those loadings, and then I think I kind of alluded to it before, where you are finding regime shifts in those loadings, or you could find out what are the um, interrelationships between these factors in the network or in the graph. And then when things start to get like less spread out, that's worse, because then things become, say, focused on a single thing, and that might help.
Thank you. I understand that some of my questions are very naughty, so you're doing a good job at managing that. But yes, so to expand a little bit more, you are looking at interactions, and when things become a little bit too closely integrated for comfort, and then you draw your conclusions from there. Again, this is something where having a Bayesian approach works much better than a standard point estimate. So I see what you're now saying, that you can recover all sorts of intervals and estimates for parameters, and say, okay, if things are within this tolerance level, I'm copacetic. Everything else, when they sort of migrate away, it's time to do something else. And yes, you can make all these decisions systematic, because once again, when you're not looking at one number but a distribution, you can grow some confidence around your process. So yeah, this is something I haven't done, but makes.
I think I can give a toy example that won't necessarily blow the lid off anything, but imagine you have a 60-40 portfolio, and you're in the S&P 500 and U.S. Treasuries, the classic. We know recently that the correlation between these two has become positive, and your whole portfolio is based on these things being negative, because the last 30 years they have had negative correlations. So what happens when those correlations become positive is your diversification becomes leverage. And that is why you will reduce the risk. So the logic is very clear. How you measure those interactions between the different nodes of your portfolio is a different thing. But in this toy model, you can very much see that if treasuries are moving down and equities are moving down, I basically am double levered to my equities, which is already 60% of my portfolio. So now, maybe it's like 0.2 correlation. I just can add that 0.2 to my exposure, and that's not what I want to be happening. And so you have basically turned diversification into diversification in a statistical sense.
One of the things that I have with this sort of network approach, so assuming we have a graph, plotted on that graph are related variables, and we're looking at the degree of convergence of those variables under a correlated regime, and the degree of divergence of those variables away in an uncorrelated regime. But when I look at that graph, I see these sort of these precursors in that graph, sort of a fundamental driver, a fundamental emergent factor that then splits into two variables or multiple variables that sort of are linked by this causal prerequisite, basically. And so we're talking about Bayesian here, but I still think we come into problems with the assumption that these variables are there for all time. Yes, their strength might increase and decrease, and their relationship might increase and decrease, but there are these additional variables that lie in the path in the past, which we can suddenly find a market, a new emergent variable suddenly become the dominant factor in that graph, and totally restructuring the relationship between those variables. So I just see it as a complex muddle that I just can't, unless you have these assumptions embedded. I just see this as a non-stationary minefield.
Oh, it's definitely non-stationary, but you don't have to have assumptions. You can do some kind of dimension reduction that will help.
And perhaps maybe I'm going off a complete tangent and I'm getting everything wrong, but what I seem to pick from Derek's suggestions is that you don't focus on, and that's where a lot of my earlier investigations failed. You don't focus on some discrete or binary event once again. You look at the distribution of your parameters. You parameterize your graph, and any graph has of course a set of parameters. So you just look at distribution, you pick your intervals, and so one of the biggest shortcomings, in my opinion, of hidden Markov models has been that for me it's very difficult to figure out how many regimes are there in my HMM. And when things transition, as you said, Richard, things are very binary, very non-stationary, very unstable. Whereas what I think Derek is telling us is just to have a bit more of a look at this graph and pick some points, some spots where things start looking very different from the way they are. And his example of the 60-40 portfolio, it's a brilliant one because a correlation have flipped, but some of us are not that young, but and so we've all seen negative correlation between stocks and bonds, but and now it's flipped positive. But going back a little bit further, stocks and bonds were positively correlated. So these things, there are cycles in markets, and so yeah, I think if I understood Derek correctly, you can look at all these graphs and parameters and things like that, and instead of figuring out a specific point, just to look at how things are shaping up, and then perhaps take action.
You are right. I think that having the distribution is our equivalent of loose pants fit everything, and that's why continuous signals and confidence intervals are so helpful. And then when you're working with the distribution, like I had mentioned before, you can compare it to the previous one, or you can do a t-test. Okay, the t-test has some assumptions, but I mean, you're already working in a distilled space that you have control over. So if it requires a transform, or you use a z-score, or you modify it in some other way, you can come up with some less normal assumptions on the output. But the important thing is, what I mentioned before, that you have this like network effect, and you're assuming it's time varying. We know that this is a fact, so that must be built into what you're trying to measure. I hope it's not too over the top, and I'm very grateful for everyone else who is in the audience. Let me know if you want to come up to the stage and have a question. Be happy to clarify anything, or you have any comments. And just as always, appreciate you guys coming up.
Derek and everyone, this is Brian. I would like to say thank you. I kind of equate this discussion for me personally as I fly gliders, sailplanes, and Cessnas, but my two college roommates are retired Air Force that flew F-15s and a F-22, and I kind of equate the discussion here with when we talk aviation together, when we get on a call together. I understand it somewhat, but then you get into a lot of the upper level stuff, and it's over my head, but I feel like I'm learning, and I definitely have takeaways, and I'm broadening my base. And so for that, I appreciate everyone's input and literally dragging me along. So thank you.
Hi everyone. It was a nice discussion today. I spent on sidelines, not because of like several meetings, but it was a good talk, and I think it's a very good initiative by Derek and by everyone. So looking forward next time to take more active part, and it's really nice to talk with you and to see what you guys doing, and to learn. Thanks.
Yeah, I mean, does anyone want to bring up a topic? I feel like I've dominated the conversation, so I want to leave the floor open to someone bringing up another topic.
I reckon Bruno had a really good idea at the beginning of this episode. So next time we do this, I think when you post up this next this episode, Derek, I reckon you should put a topic for discussion, like a Markov process or something like that, so we can all bone up before we come into this, because we're in a world that's highly complex, and you know, I definitely need to get a context before I can even enter into conversations in this sort of space. But yeah, I'm really liking this discussion, and I think we should be doing a lot more of it.
Okay, cool. So I mean, everyone has my Twitter, so you guys can submit me some ideas. I still have today. We kind of just cover. I mean, we'll just discuss how this group will move forward. I think we have a good group here to discuss. We kind of covered volatility a bit. I will send out a few days in advance a topic. This is actually my first Clubhouse room. I didn't actually know how to use the interface, so getting Richard on the speaker thing and he's still stuck with a raised hand was a bit new for me.
I'm going
But
to cut my hand off, Derek. Don't worry.
I will. I mean, so far I think we covered correlation a bit quite well today, and using HRP. I do think that's probably the best way to deal with that. So we won't touch on that again. Um, we touched a bit on volatility. Um, I'm not sure. I'm sure we could go into more detail another time because I think that's kind of like an endless well. Maybe it's a default. Something that doesn't come up very often is like system health monitoring. And how you do that in a quantitative way to determine the health of your systems. That's something I find is very practical. And a lot of people can come in, or potentially like network effects. And we kind of touched that as well. Um, I've been reading this book by Hari Krishnan and Ash Bennington called Market Tremors. And I was a big fan of his on the second leg down. He discusses this world of network effects and dominant agents in mean field games. I think it's quite good. It's not very quanty, so to say, but because I was using graph theory basically, and what I had discussed earlier, I think tangential. I don't know if that's interesting, but please feel free to submit your ideas, and we can all kind of, as Richard said, bone up on the content, and then we can come in with, a general idea. And I'm also happy to maybe if someone also wants to present an idea, like something that they're using or an idea they found very good for like 20 minutes maybe, and just have a conversation about that. And then we can all kind of have like an open-ended discussion, because I named this brainstorm because the idea of this group is to share what we know as much as we can and clarify with each other, from around the world, what different people are using. Obviously we protect our employers IP and all that, but I think it's beyond that. Just one good idea a year or a quarter, hopefully, is worth a lot. And to get everyone's different expertise, to explain stuff to us that will help us grow, I think is the most important thing. So not only just meeting everybody here and the listeners in the room, but also to try to answer as best we can and to learn from each other's expertise, because I can tell, with different people's backgrounds, how we approach things are a bit different. Although now I know Bruno P and I are really pretty closer on the same page. Bruno sees economics background, and econometrics I think might be an interesting topic as well. But I don't know enough about that to suggest a topic.
Many
I think
thanks,
one
Derek.
one
Look,
subject.
you go,
Sorry, go
Bruno.
on, Richard. Okay, one topic that we touch on, but really superficially, is complexity and emergence. And I myself, I know little about that, but I feel that we can use the general findings of this school, so to say, but I don't know if we can apply directly what we know from complexity and in finance. Perhaps this could be the topic of next week.
That might be interesting, Bruno. Just interestingly, there's a couple of big names in the complexity area, like Ole Peters and Nassim Taleb, etc. But also Brian Arthur from the Santa Fe Institute. He's done a lot of work on the real nature of markets, and talking about things such as the what is it called, the increased returns as opposed to the diminished returns you find in tailed series, and that there's a lot of important work he's done there, which is fairly sort of academic, but I think you probably can drag out some practical applications out of that. But you'll find that coming sort of out of the areas like the Santa Fe Institute in California. There's a lot of work they've done, particularly in the economics area on complexity.
So I'm going to ask a final question, I guess, before we wrap up, and I will ask this to all of the speakers. What would you like to get out of this group, or where do you see this kind of call going?
I want to download as much from your brains as possible.
But also, as you said, Derek, make sure that we sort of compare notes. I know how difficult it is to do all the things that you were saying, protect other people's IPs while making sure that the flow of communication and ideas circulate freely. So I think, well, obviously, you struck an amazing balance today, and it's very, very possible. And I feel very, very, positive about expanding this. I don't really know where we could go, but I think it was a hell of a start today, and it was also very productive, which is was another very very positive.
Yeah, I'm really glad for the talk. Going forward, I think this format is really good. I had a different idea of what we would be doing when you first reach out, Derek. But this this talk on the Clubhouse is amazing because, well, anytime someone with a different perspective can come in and talk with us. I think what I expect to get from this is to download not only from your head, Derek, but from everyone, and share as much as possible too.
Yeah, same here. I think it's would be nice to exchange ideas because obviously we work on many different topics, and sometimes it's what I found useful, like I think someone said to compare notes. Right? You have done sort of, we talk what we have done. Maybe you choose this path, I choose that path, and then it's interesting to see what could have gained, right? Say from using your experience, right? So and therefore, and of course, it's good also if it's maybe more technical. Sometimes it's some stuff, some models are complex, and it's always good if you say, oh, you can share some of your implementation. Then it also gives you a little bit like a direction, right? It gives you some kind of feeling what I can do. I can do similar to you, or maybe I can do in a different way. So it's good stuff.
All right. I will try to make this on Thursdays to kind of dodge Jerry's event. I had messaged him about this group anyway, but we'll try to make it a regular Thursday thing at this time. And I hope to hear from you guys through Twitter, submit ideas, or reach out to me. And, we can also have other chats or send messages or whatever. I thank everyone for coming, and thank Richard for the recording, and all of, Bruno P, Bruno C, Arthur, and Brian for joining us on stage today and sharing their thoughts. Everyone have a nice day.
Thanks very much, guys.
Thanks, everyone.
Thanks, everyone. Have a nice weekend.